Hi, this is Kim Camarda with my edition of This Week in Wealth. It's Friday, February 19th, and just a quick update on the markets and the economy. This week, Congress got started with their hearings on the GameStop craze. Some things being thrown out there, like the financial transaction tax we heard come up. So hopefully all of this will get chalked up to just a little posturing and political theater. So hopefully it'll quietly dissipate. But anyway, spend a few minutes talking about what's actually going on in the rest of the world. Global bonds off to a weak start this year, mainly due to the rise in interest rates and inflation expectations. I think I've heard Jeff say on some of his past videos that if anyone tells you you can't lose money in bonds, they are probably wrong. If you held the TLT, which is the ETF for the long bond, you'd be down 9% this year. And that's been an area that we sidestepped in some of our allocations, preferring to be in the short or intermediate bonds, as well as trying to seek income from investment-grade corporates and preferred securities. So what is driving some of this move? It's not so much inflation fear as perhaps a move toward inflation of a more normal rate. The 5-year inflation break-even rate jumped 2.3%. And what does that mean? That means investors believe that inflation will average about 2.3% per year for the next 5 years. And that's a pretty big move considering the U.S. economy hasn't seen inflation above 2.5% since 2011. So those rising interest rates and this inflation expectation has been a boost for commodities. We're seeing that at the gas pump, right? With the price of oil getting back over $60 a barrel, copper at its highest levels since 2011, gold lackluster and not participating in that so much. Bitcoin also up. It's 55,000 for the first time in history. I'm sure some of you have seen that story, the poor guy who's got his encrypted hard drive that has his Bitcoin on it that he bought at $7. It's worth hundreds of millions, particularly now with this rise to 55,000. He's got 2 tries left. He says he's largely made peace with the fact that he'll never see it. So what else is rallying? Well, just about anything you can think of. Housing, if you've got property to sell, now is the time to do it. Existing home price data saw a jump in January of 14% from a year ago, the highest January on record. I know some realtor friends or whatever, inventory is tight. A lot of stories about folks, particularly here in Florida, moving down to Florida, buying things sight unseen and just putting bids on properties and, snatching them up because they want to move. There really isn't anything. And if they don't jump on it and they waste time, it disappears. So what about stocks? The market pretty much right now, sort of flat this week, took a dip in late January, but we saw investors rush right back in. So far in February, S&P up 5.5%. NASDAQ, the Qs, also up 5.2%. Overseas, emerging markets, which we positioned back into emerging markets and international. Emerging markets up 8%. The rest of the developed international probably also up about 5%. Higher commodity prices are probably boosting some returns from those resource-dependent emerging countries. And also the weaker dollar, just better for foreign equities. So speaking of the dollar, it has been flat so far this month, but down 9% from a year ago. Of course, as the Fed and Congress provide round after round of stimulus. This one, of course, hopefully just about in the net. All the money and the fiscal actions will boost U.S. GDP growth this year. Goldman Sachs just came out revising their forecast to a whopping 7%. Bank of America Research, not far behind them, projecting 6% growth for this year. And if those outlooks come to fruition, it's going to be the strongest GDP growth since 1984. Near term, the big economic data point this week was retail sales. Largely expecting, after the past few months, expected a soft gain for January, but the report came in hot across the board. Increase of 5 points. Oh, excuse me, I'm just referring to my notes here. Yeah. The 5.3% rise really reversed the declines that we did see those prior months based off of COVID-19 stimulus. So whether that money, as we've said in the past, was supposed to go toward bills, it was put to good use in the retail sector. Corporate earnings season was also another hot area. It's just about wrapping up now, but a stellar quarter. Analyst expectations were just blown out of the water. 79% of the S&P 500 companies who've reported their results already, seeing 14.6% above consensus estimates. So biggest aggregate earnings surprise since 2008. So to put it all together, I mean, we're seeing strong economic data coming out, corporate earnings blowing it out of the water, stimulus hopes pretty much in the net, so I'm sure that's going to be passed here right quick. And also the quickly improving COVID cases. We're seeing that drop off dramatically. More people getting vaccinated, 15% of the population so far, with increases in availability and getting those pushed out to people. So all of this setting up for the reopening scenario that we are positioned for. But all of that looking good. Of course, on the con side, continuing to increase debt. We've got the lofty valuations on a lot of companies, a lot of that talk of, bubbles. So good things going on. Do have to acknowledge that there are some cons out there on the horizon, and the market never goes straight up and to the right all at once. We take breaks in between, so not unusual. We're entering a seasonally soft part of the year for equity returns. And like I said, sort of flat this week. Wouldn't be surprised really to still see a little bit of a pullback and some sideways action so we can work off a little bit of this exuberance. But other than that, the forecast for 2021 looks pretty good, and things are on track. So hopefully we'll get that economy reopened and get back to some kind of normal. I'm looking forward to that, and I'm sure you are too. All right, so that's all we've got for this week. I hope that you found that informative, and I'll look forward to speaking with you again next week. Thanks so much. Have a great weekend.